In this video, we're going to be looking at the accounting for income tax when we have differences between how items are reported in the financial statements under GAAP and on the tax return under the Internal Revenue Service Code. We're going to be using exercise 16-3. It's on page 911 of your textbook. In this problem, the company has acquired an asset for $80 million and will depreciate it using straight-line depreciation over 4 years. Their pre-tax income, which includes this depreciation expense for the financial statements, are given over the next 4 years. For tax purposes, the company uses an accelerated method that is in the tax code called macros. And using macros, as you will learn if you haven't had a tax class already, is based on a method that is similar to double declining balance with a half-year convention. If you don't remember those terms, go back to Chapter 9 that speaks about depreciation, and you can familiarize yourself with them. The tax rate for the next 4 years is estimated to be 40%. And in this problem, we are given the taxable income. Now, in these accounting problems, be alert. If you are presented with the taxable income, that's going to make the determination of the current tax payable fairly straightforward. However, problems can be written which give you the accounting income, and that includes the depreciation amount for financial accounting, and a separate amount for depreciation on the tax return. In calculating the taxable income, you have to look for the difference between the two. In our PowerPoint slides, we show this. So if you go over to either the PowerPoint slide or the example in the textbook using Wood's temporary services, you can see that, for example, in 2011, the accounting income is $100,000, and since there is $8 million more on the tax return, 33 versus 25 on the financial statements, the taxable income is reduced because we have more deductions on the tax return than expense on the income statement. Eventually this will work itself out. The slide before this on the PowerPoint gives us the handy little chart that's also in the textbook that helps us to quickly identify whether we're dealing with a deferred tax asset, those indicated in yellow, or a deferred tax liability, those that are shaded this bluish gray. In our problem, we'll be dealing with a situation where we use accelerated depreciation on the tax return, straight line depreciation on the income statement. So we have a worksheet available for this on the portal, and we can begin to fill this worksheet up from the given information. So just take a second and update the worksheet if you have not done so already with the information that is given on the problem. You can pause this video while you do that. All right, the first thing we're going to do is determine the tax payable, and we'll do this by taking the taxable income and simply multiplying it by the tax rate. And we'll do that for each of our years. This signifies the current tax payable. It will be a balance sheet item, and we will use it to determine our income tax expense for the period. So now let's take a look at our timing differences in the next step. To do this, we're going to look at the timing difference each year. So we're going to take the straight line depreciation and subtract out the tax depreciation. So in 2011, we have $5 million more on our tax return than on our income statement. We can then copy and paste this, and we see that we have a temporary difference in 2011 of 13 million, and then it reverses itself in 2013. So at the end of the day, there will be no difference in what's reported on the income statement and what's reported on the tax return. When I say the end of the day, I mean at the end of 4 years. At the end of 4 years, we will have shown $80 million in depreciation expense on the income statement, and we will have deducted $80 million on our tax return. In 2011, the future differences that remain are the 13 million in 2011, the 5 million in 2012, and the 13 million in 2014. So the cumulative difference right now in 2011 is a difference of $5 million. So in the future, we will have a situation where we have $5 million more on our income statement than on our tax return, and that creates the deferred tax liability. So we will enter our $5 million here. So at the end of the day, our year-end balance, or at the end of 2011, our year-end balance is the $5 million times the tax rate of $2 million. We had no opening balance, so we need to have a credit to our deferred tax liability of $2 million for the end of 2011. So for our 2011 journal entry, we will debit our income tax expense, but we'll come up with its measurement by adding the two credits, which includes our current income tax payable that we calculated above, and our deferred tax liability, which we have just determined needs to be a credit of $2 million. So our income tax expense for 2011 is going to be our current payable plus our deferred tax liability. In 2012, the future deductions will include the $5 million in 2013 and the $13 million difference in 2014. So we have a total of $18 million. So again, we go down to our cumulative difference, and our cumulative difference 2012 is going to be 18 million. We multiply that by 40%. We had a previous balance of $2 million, which means for this year, our credit to the deferred tax liability has to bring the balance of that account from 2 million to 7.2 or 5.2 million. So for 2012, a journal entry will have the same setup for debits and credits, since we'll be increasing the liability this year. Again, our income tax expense is to balance. Our income tax payable comes from our calculation based on the taxable income for the current year, plus the increase in the deferred tax liability that we calculated above. So our income tax expense will be 140 million. Now, 2013, the only future difference will be the 13 million from 2014. And for 2014, we will have no temporary difference. So our year-end balances we can copy and paste our formula. For 2013, our year-end balance has to be $5.2 million in the liability account, and we have to have a zero in our liability account by 2014. Our ending balance in 2012 was 7.2. Well, that balance has to be decreased by 5.2, so we're going to have a debit or reduction in our liability account in 2013 of 2 million. In 2014, we began the year with a balance of 5.2. We have to bring that down to 0. So we will debit our account for 5.2 million in 2014. So our journal entry for 2013 will be a debit to income tax expense, since we'll be reducing down the deferred tax liability. We'll be debiting it, and we'll again be crediting our income tax payable based on the taxable income we calculated above. For 2013, our deferred tax liability, we said, is going to be 2 million. So why don't we just type it in there so we don't have a negative number. Our income tax payable is 148, which means our income tax expense is our credits minus our debit, or 146. 2014, our account setups will be the same. Debits to income tax expense and deferred tax liability, a credit to income tax payable. Problem there. And for 2014, we need a debit of 5.2 million. So I'll type in our amount here, or we could say negative and reference the cell. And we can then take our income tax payable and our tax expense for the year is our credits minus our debits. And that's how we're going to account for this timing difference. Again, our tax payable is based on the taxable income which was given in this problem. We have our temporary differences between financial and tax depreciation based on those cumulative differences over the years. We've established what the balance needs to be in the liability account, and then we've determined what adjustment will be made to a debit or credit to increase or decrease the liability account based on the cumulative temporary difference. And from that we can then prepare our journal entries, remembering that the income tax expense is based on the income tax payable for the period and the change in our deferred tax assets and our deferred tax liabilities.